Well, good afternoon, everyone. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. So, welcome to this week's Mortgage Minute, as we tell you a little bit about what's going on in the mortgage world in terms of interest rates, the bond market, as well as pertinent information about loan products and helpful tips about how to navigate through the loan process and so forth. So, again, welcome. Nice day here out in the Coachella Valley, the Palm Springs area. We're a cool 106. So, yes, we consider that cool in this part of the world. We always like that better than what we call the one teens, but those will be coming up soon, I'm sure. So with that, we're going to go ahead and get right into the show. As you know, I like to give you a quick update on interest rates and what's going on with the bond market. So again, the best way to check on interest rates on any given day, go to our website. We have a rate grid posted right on the homepage. Jeff's going to pull it up here in a second, and there you got it. You can see here. The good news this week, I think, is stability. We've stayed at a relatively stable range now here for a couple of weeks. Don't let the news media tell you otherwise. We're not in the sevens. I can still arrange conforming fixed rate loans in the mid sixes, FHA and VA just a tad under six. So we're holding really well at a nice stable level. It is a 6% mortgage market. I think we're going to probably be in that at that level for a while. And part of the reason for that is when you look at the 10-year bond chart. Jeff's going to pull that up, and what you're going to see is look at that for the last 5 days, relatively level. We actually had a little bit of an uptick starting yesterday, and that's starting to settle down a little bit today. So, yeah, there you go. Jeff's showing you how it kind of blipped up here starting midday yesterday into this morning, but we are seeing a little bit of relief now. So that's a good thing. We've been basically in this 420, 430 range for a couple of weeks. And again, the more stability we can get in this regard, it's going to be good, I think, for all of us in terms of what we're seeing with mortgage rates going forward. So what's going on in the financial markets? What kind of economic data points were going on this week? Actually, a pretty light calendar. One thing, and this is the reason why we had this little uptick in the 10-year bond yield yesterday, is what I call Fed speak. In certain weeks, there'll be a pretty sizable calendar of different Fed governors and presidents who are giving speeches or being interviewed, and the market does really hang on to their words, what they have to say. And this week, between Monday and Tuesday, we had two Fed governors and we had one Fed president give a speech or be interviewed, and all three of them basically their message was saying that a rate cut is not appropriate yet. And of course, the bond market, as we like to say, they respond with reptilian-like minds to stimuli. Well, those kinds of comments from, important Fed governors and presidents, the market reacts to it. And so that's a little bit of what happened yesterday with the 10-year bond yield had been in the sort of the 423, 425 range and shot up over 430. It was really because of their comments. Today we had initial claims, which are basically flat. Initial claims for unemployment, 233,000, pretty much unchanged from last week. Durable goods were weak, only up 0.1%. The big indicator, the big economic data point this week isn't until tomorrow. It's the PCE, the Personal Consumption Expenditures Index. That's the Fed's favorite inflation gauge, as we always say. It's forecast to be flat. Let's hope that's the case, because if it comes out that way, I predict we're going to have a nice day in the bond market next week and see some rally in that yield. Maybe we can get down into the low 420, or who knows, get under 420 into the 14s. That would be nice. And of course, we'll see a commensurate improvement in rates, mortgage rates, to go with that. One other thing I want to touch on real quick before we get into our Q&A session with Jeff. Case-Shiller, you know about that. That's an index that's published. Yale professor Shiller, and he's become sort of the housing market expert in terms of home prices. They just released their latest data, and home prices continue to rise. So, folks, any of you out there waiting for home prices to fall, I would not suggest that. If you think you have any chance at all of qualifying to get financing to buy a home, you're better off doing it now, because home prices are not overall falling. There's pockets, of course, in certain markets, but overall home prices are holding firm. There's still not enough inventory. That's part of the reason home prices are going to continue to be firm. And when we do see some improvement in rates, I think home prices are going to go even higher because of the unbelievable large amount of pent-up demand for housing. So just thought I'd throw that in to let you know. Home prices are steady. They're creeping up. So if you want to get into the game, now's as good a time as any. So with that, we're going to go ahead and bring Jeff back because we're going to have a little bit of discussion about the home equity market because there's a lot going on, particularly with one of the federal mortgage agencies. Hi, Jeff.
Hey, Art, thanks for having me. Before we dive into this, I read something early this morning that, we all like to put a little wager on things. And as I understand it, now there's going to be an opportunity to put wagers on what are the indexes. In other words, when you talked about the PCE and, consumer price index, people are going to be able to bet on that.
Well, I hadn't heard that, but I'm not surprised. Of course, then I'm wondering, with all those who participate in the financial markets, is that going to be okay for them to bet on these statistics when they're maybe work in a field where those statistics have something to do with their work? I don't know. That'll be interesting.
Well,
It's kind of like baseball players that can't bet on the games, right? I don't know.
Yes. Well, the nice thing about it is you can only bet $1. And so you can only win it, you can only win a little bit. So it's not a big deal, but I thought that was fun that now they have to say, we're going to gamble on everything. So if the number is supposed to be, 3.2 and it's 3.1 and you bet properly, you can win, 1%. So anyway,
I'll have to check into that, which actually brings up something I forgot to mention on our previous, update on the markets and the bond market and mortgage rates. The current prediction for a Fed decrease in rate, which again, remember, most recently they're saying only one reduction is going to happen this year. The latest probabilities I saw were a 15% chance of a 0.25% rate cut in July next month.
Oh, wow.
But a 60% probability in September and a 95% probability by the end of the year. So we'll see where that plays out. I think the 60% chance in September might be a pretty good bet. We'll see.
Yeah. Hey, before we get into today's topic, I just have one other question. Tonight is the presidential debate, the first one, and it's real early in the debate season. How will that affect, or will it affect the rates at all, in your opinion? Because you've seen it for 4 decades. So what do you think?
I don't think so. In fact, in all my years, I've always kind of had a feeling. I felt like this notion that elections matter when it comes to mortgage rates. I think that's way overdone. It's all about the data. It's all about what's going on in the financial markets, all these different data points we talk about all the time. That's really what's driving these numbers, where the bond yield is and where, of course, correspondingly where mortgage rates are. There might be some reaction to the debate. I think tomorrow's reaction in the markets, in the bond market in particular, it's not going to be about the debate. It's going to be about, like I said, the PCE. That is being anxiously awaited. And the bet is it's going to be flat. And like I said, let's hope that proves to be true, because if it does, we should see a pretty good little bond rally tomorrow.
That'll be exciting.
Yeah.
Well, okay, so let's dive into today's topic, because it's how to unlock your home's equity. Because you shared something earlier this week in a meeting you and I were in that there's some new tools or gadgets in your industry. I don't know what to call them, the programs, things of that nature that right. could make this whole idea of how can we unlock that equity in our home. Because you've told us in the past that it's at the highest level it's been in a long, long time, maybe ever. And how do we get it out? How do we get it out?
Home equity is at record levels, and of course, as we keep harping on, there's so many homeowners with low rates on their first. Their values have gone up, as we've been watching, and as I just commented on, they're still going up. So there's all kinds of equity sitting there. So then the challenge is how best to access it. What terms do you want to access it are going to be best for you in your situation to access that equity? And yeah, that's one of the things we're going to get into. And of course, now we have Freddie Mac is going to enter this arena, which is really unheard of. It's a big surprise.
Is that a real push because of where we are in the bit of a housing lockup, with the rates being high and the demand being high, but the inventory being low?
Yeah, I think so. I mean, it just seems common sense that they would eventually step in. And by the way, folks, what Jeff and I are talking about is Freddie Mac, by the way, Freddie Mac is the Federal Home Loan Mortgage Corporation. They're what I call a quasi-governmental agency. People think it's part of the federal government. It is not. That's true with Fannie Mae as well, by the way. These are quasi-governmental agencies because they were created by government charter, and they are under conservatorship by the federal government, the FHLA. or the FHLA, but they're private companies, and Freddie Mac recently announced that they had a plan to offer second mortgages, and it was under federal review, a sort of a review period, and then they just announced earlier this week it's been approved. So
Mhm.
Freddie Mac is now going to be buying second mortgages from lenders. And I think that's probably going to get kicked off probably somewhere around maybe end of third quarter this year, or certainly before the end of the year.
Well, I know when you first broke that news, you thought maybe it was going to be, a while before they went through that discovery process, but it really, it kind of got on the fast track. I guess it wasn't approved by the FDA, but it was by the FHLA.
Yeah, and actually that's the Federal Home Loan Mortgage Corp, so FHLM, but
Oh,
or LC. But anyway, yeah, this seemed like it got fast tracked.
yeah.
When I first heard the proposal, because again, this is a pilot program. It's not just they're just opening the floodgates. It's a pilot program. So when I first heard about it, I thought it was going to take a while for this review period to occur, but they've already gone through it. It's tentatively approved. So I think the rollout's going to be soon. And a couple of features about it. One is it is a pilot, so there's only going to be 2.5 billion of funds available under this pilot program. Now that
I'm sorry.
sounds like
How much did you say that was?
2.5 billion.
Oh, with a B. Okay. 2.5 billion.
Yeah.
Okay.
Now that sounds like a lot, but when it comes to mortgages, it's not really that big of a number. The pilot's going to go on for 18 months. The maximum loan amount is going to be relatively modest, just under 79,000. And so when you do the math, that would work out to maybe 32,000 loans, nationwide over 18 months. Which again, in the scheme of things, that's not really that big of a number. And to be eligible, apparently, you're going to have your first mortgage for at least 24 months. So essentially, you've got to already own your home. That first mortgage that's already in place has got to be there for 2 years before the Freddie Mac program is going to be available to you. And it's only going to be for primary homes. So no second homes, no rental property. But it's going to be interesting when they roll this out, what the pricing is going to be. I think there's a belief that this might make the second mortgage market a little more competitive with a big giant like Freddie Mac getting involved, and that hopefully maybe that'll drive down the rates on home equity loans in general because of their participation. But we'll have to wait and see. It could be the opposite. They could come in the market with lousy rates, and the pilot program may not be that successful. We'll just have to wait and see.
Well, so what would as this goes through, what's this going to mean for a homeowner? What's the benefits for us?
Well, what it's going to benefit the homeowner is just another choice, another option for getting an equity loan, because the equity loans are a little bit interesting in that, where you can get them maybe is not quite as extensive as you can with the first mortgage. I mean, most of the major banks offer some sort of equity lending. Mortgage bankers have not been traditionally in that market much. They're getting a little bit more involved now simply because the overall market, mortgage market, has been soft, and they're looking for ways to generate more revenue. And of course, us brokers, we do try to, and I've done equity lines and fixed rate seconds for many, many years, decades, in fact, because as a broker, of course, we have options in terms of many different lenders we can, sign up with and be able to deliver the product. So Freddie Mac's entry, I think, is just going to create another option. And again, hopefully maybe bring down some of the rates on this product overall by making it more competitive and opening, with Freddie Mac's involvement, there's going to be more lenders now than ever before probably offering equity loans. And I think overall that's going to help more than hurt. So.
Fantastic. Well, I know there's a new home equity line that you have. By the way, if you're just joining us, we're talking about home equity and unlocking that home equity without doing what I think forever we've done. We've said, hey, we want to refinance our home and get the equity out. But, we have all those low rates out there. So now there's a new program called Fixed Line HELOC. What is that all about?
Yeah, we're pretty excited about this. This is a very unique product. The problem with HELOCs, again, for everybody, HELOC is Home Equity Line of Credit. It's an acronym. The issue with HELOCs, they're very popular, but there are some concerns about HELOCs. One, of course, is it's a variable rate loan. It doesn't adjust on a scheduled basis. It only adjusts when the Fed funds rate changes, because that directly affects the prime rate that most HELOCs are tied to. So that's been one objection to HELOCs. And then on the flip side, equity loans, what we call HELoans, the objection on getting those, because right now some of those HELoan options are priced very well, in fact better than a HELOC in terms of rate. But the disadvantage to the HELoan and why they're not more accepted is the fact that they are actually a fixed rate loan. While normally that would be appealing for most homeowners compared to a variable rate loan, but what it lacks is the flexibility of a HELOC. With a fixed rate loan, it's a fixed rate. You get all your money at once. It's a one-time deal. You can't access that loan again as you pay down the balance. You can't access it again for the excess credit available because you paid down the balance. And when you do make payments and even extra payments on a fixed rate second, your monthly payment the following month does not change. It remains the same until the loan's paid off. So the fixed line, it's a HELOC, but a couple things about it. Number one is the rate is fixed when the loan is registered and the rate is locked, and it's fixed for terms of 15, 20, or 30 years. Now that's the borrower's choice, what term they want, 15, 20, or 30 years. So when you get that line of credit and you draw your funds, your rate's going to be fixed based on what amortization term you chose, 15, 20, or 30 years. And then the other thing about it, and this is what's really kind of cool, is unlike a fixed rate second, you get a fixed line, and let's say you pick a 30-year term, and you got a monthly payment that will be a 30-year amortized term. Well, as you make that payment, or maybe you're even going to pay extra, as you pay down the balance, that difference between your original loan amount and your balance is available again. You can draw on it, just like a HELOC. Again, that's been the big objection to HELoans in the past. I want that fixed rate loan because it's actually got a little bit better rate than the HELOC, which is true in many cases. But then I don't like the fact that I'm going to get all this money at once when I don't really need it all at once. I really want to have this loan partly for a rainy day to access later. And so I'll go ahead and go with the HELOC, even though the rate's higher, because I want that flexibility. I want to have the ability to get some money now, but then have some money available later for a later project that's planned, or maybe just for a rainy day. So now with the fixed line, you're going to get a fixed rate right from the beginning. It's never going to go up. Now it's never going to go down. It's fixed, but as you pay down that loan, your monthly payment required the next month is going to be recast, readjusted downward because you've paid down the balance, and then you have that unused credit, that portion between your current balance and the original loan amount, you can access again during the draw period. And with this program, it is a 3-year draw. It's not the traditional 10-year draw that many HELOCs have. It's a 3-year draw, but that's still a good amount of time for people to be able to have that access to flexibility and get money when they need it. The other good thing about it is the maximum loan amount has been reduced. The HELOCs that we've had up till now, it's $50,000 minimum, which for some people, that's just too much. I mean, I get a lot of inquiries for, I need 25, I need 30, I need, 38, whatever the number is. This one has a minimum of 25. So for those of you who have a modest need for some tapping into your equity, and a $25,000 line of credit is going to be, enough for you to accomplish what you want now and for the next 3 years. This is a great option. $25,000 is the minimum loan amount. You do have to draw a minimum of 25 at closing. But for those of you, because I've turned away a fair amount of people who wanted a small HELOC well under 50, and they just weren't willing to, bite the bullet on 50. So this gives them a very good option.
So I'm just curious, and let's say, for instance, okay, somebody says, I decide, hey, I just need $25,000. But can I set the limit the line is higher? So within that 3-year period, I could go back and say, well, I need another 20 or I need another 50, as long as I have that top line. So I could do that, right?
Exactly right. I mean, and that kind of goes along with, typical HELOCs, where I often will tell people, look, like with one HELOC lender I deliver loans to, you're going to get the best rate if you ask for a $100,000 line of credit. If you want less than that, like 50,000, the rate's 0.5% higher. So I'll get people who want 50 or 60, maybe 75 grand, and I'll say, hey, guess what? Maybe you should go to 100 because you're going to get a better rate. You don't need to use all that 100. It'll just be there sitting there. You're not going to be paying for it unless you draw on it. And that's the strategy. Well, with this program, with the fixed line program, you can do the same thing. Maybe you need only 40,000 right now, but if you got a lot of equity, it may make sense to apply for 75. And again, you'll just draw your 50. Well, and again, on a 75, the way that works on the draw, it's 25,000 minimum draw or 3/4 of the line amount. So it'd be 3/4 of 75,000. But nonetheless, you just draw the minimum, and then the unused portion just sits there. You're not paying on it because there's no balance. And yeah, you can use that same strategy with this fixed line program.
Art, why wouldn't somebody go that option versus a traditional HELOC or a HELoan then?
Well, one reason that maybe doesn't seem apparent unless you think about it. Again, we just got this week, so I'm only now being able to start talking about it. What I anticipate some folks might say when I'm giving them, say, a worksheet on this fixed line product and a worksheet on a traditional HELOC, is you're going to say, okay, yeah, the fixed line, that looks like a better deal. In fact, on rate, it is a better deal right now. I'm expecting somebody, homeowners, maybe someone who's got a better crystal ball than I do, is going to say, well, I like the fixed line. I like that it's fixed, so my upside's protected, but I think I'm going to go with a regular HELOC. Well, why would you do that? Well, because I think rates are going to fall. Well, I think the Fed's going to start lowering the Fed funds rate, maybe, yeah, once this year, but they're talking 4 times next year. And there may be more after that. Well, you start adding up, 4, 5, 6, 8 Fed fund rate reductions, that will directly benefit the traditional HELOC, because remember, it's a variable rate loan. So, and I've been harping for almost a year now, right? The Fed funds rate has not changed in a year.
Wow.
It's been at the same level since July of 23. I've been saying to people for a long time, now's a good time to get a HELOC because we're on the precipice of rates starting to fall, we hope. And they may fall a good amount. And if you're on a HELOC now or getting one now, you're going to ride that down on your rate. So that could be a reason somebody will still say, I'd rather have the regular HELOC that's a variable because I'm betting on rates falling.
Gotcha. Okay, so that makes perfect sense. Well, hey, I don't want to forget about our senior homeowners. What's available for them?
Yeah, this is a really interesting product. I like it a lot. I think it really serves a good purpose. We'll run into homeowners who are like, they got a low first mortgage with a low rate, and they've got a lot of equity and they want to tap into it. But, I've seen some instances now where people are like, they're approaching retirement age, but they're not quite there yet. They're still working, but they may have had a change in their income. They may have had to change jobs and they're earning less than they were before. And they're kind of a little bit stretched financially and they're having trouble even qualifying for a traditional HELOC or HELoan, because HELOCs in particular, can be pretty tough to qualify, which, by the way, that's another benefit of the fixed line HELOC. Going back to that, you get to qualify at the start rate. That means your qualifying rate on the fixed line is better than on a HELOC. So you should be able to qualify for more money. But then with this product for senior homeowners, this is for what I would call the almost senior homeowners. You have to be at least 55. You don't have to be 62 like a reverse mortgage. You have to be at least 55. You do have a credit score requirement, a minimum of 600. But other than that, you can apply for a second mortgage behind your low interest rate first mortgage. And when you get that loan, now the loan amount you're going to get is going to be, it's not a standard loan to value matrix like, 70%, 80%, 90%. Instead, it's like a reverse mortgage. We have to get your birth date. We would find out what loan amount you want to get. And then there's a formula that will determine based on your home value how much of a loan amount you can get. And then the benefit of this option is, first of all, you don't qualify based on traditional debt ratio. You qualify based on some financial evaluation and determining your residual income, which is pretty easy thing to meet in most cases. And then the best part is, if you get this loan, there's no payment.
Oh,
you don't make any payments. It works like a reverse mortgage. You can make a payment if you want, but otherwise the interest on the loan accrues back to the balance, just like a reverse mortgage. You don't have to pay it off until you vacate the home, such as you sell it, or if you keep the home, you're 58 and you keep the home until you pass away, then you pay it off, or your family does when you pass away. So the point is, like a reverse mortgage, you don't have to make monthly payments. So if you're financially strapped, which is why you need this, because maybe your income got reduced again, you're approaching 62, but you're not there yet. This is a great option to really give people some financial benefit and assistance in getting maybe repairs, maintenance done on their home, consolidating some debt, and then not have the burden of having to make monthly payments unless they want to. Otherwise, it just grows over time, and they just pay it off when they vacate the home.
Art,
So,
is that something that can be, is that, let's say they have that low first, can that be combined, even though it's not a reverse mortgage, but this is a reverse mortgage product called Home Safe Second? Can
what do
they
you mean by?
combine the two?
You
Like if they
mean
have a
combine
traditional mortgage?
get rid of the first mortgage?
No. Let's say they have their traditional first mortgage,
Right.
and then they get the Home Safe Second. Maybe they have, you know, $500,000 or $600,000 in equity. They just want a $75,000 or $100,000 loan. Does the mortgage still stay in place, or does it have to encompass the new one?
Oh, no. The first mortgage, the existing first mortgage is untouched.
Okay.
That's separate. Yeah, that again, this is like anyone who would be interested in these other, equity loans we're talking about, the HELOC, the fixed line, a Heloan. This is for the special category of the near senior homeowner who maybe is a little bit more financially stretched, is likely, in fact, I've got a past client I'm dealing with now trying to help her with this. Is, her income change, it's lower than it was 8 years ago. She's not 62 yet. Couldn't get her qualified on a traditional HELOC or HELOan. She wouldn't qualify even for the fixed line. So this is a good option for those who can't meet traditional qualifying criteria if they're 55 and they're financially stretched and they need some help to tap that equity for, useful purposes like, maybe badly needed repairs of their home and or debt consolidation. Those are usually the two main reasons for, searching out this kind of money. And the whole thing about it is it's a non-recourse loan. So again, if they get this loan, they stay in their home for the duration. Even if market values fall years from now and their existing first and their home safe second together are more than the home value, they're not responsible for that. Their family is not responsible for that. They are not going to have to pay that deficiency balance. So that's another beauty of this program.
Art, these are some great programs that, either they've been existing, but not for long, or just come online that you're sharing. There's a couple other questions I have. What is an LOC option in the HECM reverse mortgage?
Yeah, that again is something that is just not well understood. Reverse mortgages, just to review real quick, when you get one, you have a multitude of choices as to how you want to access the funds. You can take a lump sum. You can take a lump sum plus a monthly payment for a specified term. You can take a lump sum and a monthly payment for your lifetime. And then the fourth option is you can take, either a lump sum and a line of credit for the unused portion. Because remember, when you get in reverse mortgage, if it's a refi situation, you don't get access to all the money for the first year. You can only access up to 60% of the loan amount in the first year. And there's reasons for that we don't need to get into today. But the point is, so oftentimes people will take some amount of lump sum at closing, and then they need to decide how they want to access the remaining portion. And guess what? The LOC option, line of credit option, that is the most popular option among reverse mortgage borrowers. 66% of reverse mortgage borrowers take the LOC option.
Wow.
And what is really cool about the LOC option is, I would say, two things. One is, right now, reverse mortgage rates are relatively low compared to HELOC rates. Again, HELOCs are going to be 8.5 plus some margin in most cases. Reverse mortgages right now are, the rates are like mid sixes. Even with MI added 0.5%, it's maybe 7.25. Relative to a HELOC, that's a lower rate. So the LOC option in a reverse mortgage is going to give you a better rate, which of course means as you use it, there's less interest accruing to the balance. But the other beauty of the LOC, and this is the main criteria why so many people, 2/3, take this option, is the LOC, the line of credit, grows over time. The unused portion of the line of credit will grow over time. And the growth rate is based on your interest rate and the MI rate. So like for right now, like I said, let's say your interest rate on your reverse mortgage is 6.75%, and your MI is 0.5%, as always. So you're at 7.25%. So your line of credit, if you take that as the rest of the way you want to access the money after you take your lump sum up front, so then you got this line of credit sitting here with no balance. Let's say it's 200 grand. Well, that 200 grand, if it remains untouched, is going to grow based on the interest rate plus margin, which right now is about 7.25%. So you're talking about it growing like at a 7.25% rate, year to year, for at least always on the portion that's not been used. That is a great option. I mean, traditional HELOCs, that when you get 100,000, they don't just automatically grow over time to where you can borrow 110 or 120. That doesn't happen. Reverse mortgage, that's a key feature of the line of credit option. Not understood by many people, and I think once they know, that's why 66% of reverse mortgage borrowers grab that option. They really like that.
That makes sense. Well, Art, you're a wealth of knowledge. I put your information on the screen. MortgageWorks office, 760-969-5023, or Art's cell at 714-612-9035. I often call that the bat call, and he is ready to answer your calls. Art, is there anything else we need to know about this whole HELOC, HELoan, and home equity line of credit before we let you go today?
Yeah, just a few things. Yeah, one of the things I would tell our viewers a few things. Again, we deliver this kind of product to multiple lenders, and we've got some features that you're not going to see with just every. A lot of major banks are doing HELOCs and HELoans as well as credit unions and so forth, but some of them can be pretty restrictive. I'd like people to know, for example, that we've got HELOCs and HELoans for borrowers with credit scores as low as 640. A lot of the major banks won't go that low. I mean, you're lucky if they'll go below 700 or 680. We've got HELOC and HELoan programs for homeowners if you're at 640 or higher. Now the loan to value is going to be lower, but we can do that. For 680, we can get you to 80%. We can get you to 90% if you're at 700. And or actually 90% at 680, and if you have at 740, we can take you to 95% of your value. Wow. That is unheard of. So if you want to be highly leveraged on your home, and you may have a good rational reason for that, we can help you. Most major banks and credit unions, they won't go to 95%. The other thing I would point out is we can do these loans not just on your primary home, but on a second home, and most important, rental properties. So we can do all of these loans on rental properties, including 2 to 4 units, duplexes, triplexes, fourplexes. So if you're a real estate investor and you want to pull some equity out on a triplex, we can help you with a HELoan or a HELOC. So we've got those extra added little features. I think that a lot of the major banks are kind of a one menu, one product menu. We've got various options that we can help just about every borrower. So.
Well, I'll tell you what, Art, with the message you drop, or the information you dropped today, if there was a barometer, it just went way up with information because it's all good news, and it really is, making it so much easier for people to make a decision in saying, hey, we should use some of that home line of equity. You're over 55, the home safe second, that makes such great option if you have the equity to say, hey, we're going to put a roof on, we're going to paint, whatever it is, and not affect your monthly budget because you don't have to make those payments if you don't want to, but you can.
Exactly.
So,
but you can.
Well, Art, thank you so much. I really appreciate it. I'm going to dive out here. I'll let you finish the show. And again, if you're in that situation, you're thinking, there are some things I could do, but I don't have the cash on hand, but I have all this equity in my home, call Art at MortgageWorks at the office at 760-969-5023 or his cell at 714-612-9035. Thank you, Art, so much. I appreciate it.
Okay. Thanks, Jeff. Well, everyone, let's go ahead and finish up our show this week with our closing question from last week, as we like to do. And in fact, I just basically gave you the answer. Here was the question. I understand that the line of credit option in a reverse mortgage allows for the line of credit to grow over time. How is the rate of growth determined? Well, of course, as I just explained, the HECM, that's home equity conversion mortgage, the line of credit option within that reverse mortgage program has a guaranteed growth rate. The growth rate is, as I just explained, your current rate plus the 0.50 annual mortgage insurance rate. And as I mentioned just a minute ago, Right now, that means the growth rate on a HELOC or a line of credit in a HECM reverse mortgage is going to be growing right around the 7+% range. Again, the growth rate is based on the unused portion of the line of credit. Now, keep in mind what that also means is that the growth rate of the line of credit will slow as you take more and more of the line of credit loan, if you start drawing more and more out of it, so that the unused portion is shrinking. That, of course, will then also shrink the growth rate, because the growth rate is calculated only on the unused portion of the line of credit. And then the last thing, which we didn't touch on just a minute ago in our discussion with Jeff on equity lending in general. And if you had a line of credit, a HELOC or traditional HELOC in past years, particularly if you had one maybe after the Great Recession of 2008, well, many of you did probably. And if you may remember, a lot of homeowners were surprised when their line of credit, their HELOC, they got a letter in the mail telling them that their HELOC was frozen, that they couldn't access it, even though there was unused credit in that line of credit. Well, yes, most traditional HELOCs, buried in the loan disclosures, the lender has that option for them to freeze your line of credit, and they usually do that when they're seeing storm clouds in the economy and the economy's contracting, and maybe unemployment rates going up, people are struggling financially, and most importantly, if they're seeing evidence that home values are softening or going down or even collapsing, HELOC lenders will jump in and try to freeze your HELOC to keep you from pulling more money right before the home value falls through the floor. One very important but subtle feature of the line of credit option in a HECM reverse mortgage: your line of credit will never be frozen, no matter what. Again, it's a non-recourse loan, so you never have to worry about your home value falling below the loan amount on your line of credit or on your home from the HECM loan, as well as the line of credit option. So good question. Of course, we covered it kind of very much in detail, since we just talked about it in our equity lending Q&A session. But it is a good question and an important feature for anyone considering a reverse mortgage to know. So with that, let me go ahead and go into the closing question for next week. And here it is. I heard an interesting term recently when discussing real estate and a home purchase. What is a situational buyer? That's an interesting term. And so stay tuned for next week when I'll give you the answer to that, and it will be on the house. And I'll add my own little twist to what is a situational buyer. So you'll have to stay tuned for that. We'll cover that next week. So that concludes our Mortgage Minute for this week. I want to thank you for watching and listening. Please keep us in mind for all of your mortgage needs. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. So have a good weekend, and we'll see you next week. So long. Take care.